Okay, let's dive deep today. We're looking inside the engine room of a major company, specifically their latest earnings call and analyst meet.
Right. It's like getting a direct line, isn't it? You hear the leadership's take on performance, what they see coming next.
Exactly. It's where the strategy meets the numbers. You get those insights, straight from the source.
And today we're unpacking Mahindra and Mahindra M&M, huge company.
Yeah, incredibly diversified.
Right.
If you look them up on Screener or somewhere, you see vehicles, tractors, finance, IT, hospitality, logistics. It's a lot.
Absolutely. Auto, farms, services, this whole ecosystem. It's quite complex. Understanding it means looking at all these different pieces.
So our mission here really is to cut through all that and pull out the key insights from the recent Q4 FY25 analyst meet transcript and the info they shared.
Yep, giving you the shortcut. Performance over the last year, where they're heading, straight from the materials.
We're using the transcript from that May 5th, 2025 analyst meet and some key data points from Screener just for context.
Okay, sounds good. Where should we start? The big picture.
Let's do that. Overall performance, financial year ending March 31st, 2025. What were the headline numbers?
Well, looking consolidated, FY25 was pretty strong. Consolidated revenue grew by a solid 14%.
14%. Okay. And the bottom line, profit.
Consolidated PATA, profit after tax, that saw an even healthier jump, 20% increase.
Wow, 20% profit growth. That's pretty significant. And I know they highlighted a key metric, shareholder returns.
They did, yeah. Return on equity, ROE. It hit 18% for the year.
18%. And that's notable because
it's ahead of a specific commitment they actually made back in FY21. So they've really grown that return quite a bit year on year since then.
So not just growing, but getting more efficient for shareholders. What did they say drove this? What was the key?
It seemed to come down to one word, really, repeated quite a bit.
Execution.
Execution.
Yeah, they emphasized disciplined execution across the board was the main reason for these results. Okay, let's see where that execution really showed up. Their core engines, auto and farm. These are the big ones, right? High scale.
Exactly. Giants in the portfolio.
Starting with auto, how did the execution play out there?
Auto was definitely a standout. Strong execution, they said, leading to gains in market share and margins. SUV volumes grew 20% in FY25.
20% growth in SUVs. That sounds pretty fast. Did they expect that?
Well, going into the year, they targeted mid to high teens growth. They even admitted that felt ambitious at the time.
And they beat it.
Yeah, hit 20%. And that pushed their overall auto market share up 210 basis points, reached 22.5%.
Which puts them?
Number one spot for SUVs in India.
Number one. Okay. And EVs, electric vehicles.
Getting off to a good start, they said. What's interesting is by revenue market share in Q4, they became the number one electric SUV and number one electric passenger vehicle player. That's according to JITO data.
Number one by revenue. Okay, that's an important distinction. Why focus on revenue share?
Well, it indicates the value of the EVs they're selling. Their average price points seem to be higher than some competitors. So maybe not number one purely by volume yet, but they're capturing the highest value. Suggests their current EVs are, positioned a bit more premium.
Got it. Capturing value. Yeah. Any other big wins in auto they mentioned?
Yeah, they highlighted achieving a 5-star safety rating from 4 at NCAP for one vehicle. That's becoming more and more important.
Definitely.
And auto margins improved too. Up 110 basis points, reaching 9.5%.
Okay, solid performance in auto. How about farm, the other giant?
Farm also showed really strong execution, translated into big market share gains and better margins.
Market share.
Hit 43.3%. They made a point of saying how hard it is to gain share when you're already over 40%, but they did it. Up 170 basis points, their best market share ever.
Best ever. Wow. That's impressive in that market. Margins.
Farm margins also improved significantly, up 210 basis points to 18.4%. I mean, they're the number one tractor manufacturer in India, second largest farm machinery player overall.
Was that growth across the board for farm? Domestic, international?
Domestic farm revenue was strong, yeah, up 15%. But the overall farm revenue growth was tempered a bit. International markets were weaker, only grew 6%.
Right. I saw something about a really high Q4 farm margin, like over 20%.
Yeah.
Was that just a blip?
They addressed that, said the 20.8% Q4 margin is real, not a one-off. But they did add a caution. Future competition intensity will be a factor. Meaning if the market gets into heavy discounting, that could obviously hit margins, though they did say their philosophy isn't to chase volume with irrational pricing.
Okay, so maybe that 18.4% for the full year is a more stable baseline number, keeping an eye on competitors.
Exactly. Seems sensible.
Now, it wasn't all smooth sailing. The report mentioned some areas they needed to address, write-offs specifically.
Yes, those were mainly linked to businesses they'd previously called Category B. Businesses with strategic benefits, maybe, but not necessarily a clear profit path initially.
And the plan is to pivot these now.
Yeah, basically stop them being a drag on the group's profit. The big write-offs were for Mitsubishi in Japan and Sampo in Finland.
But they got value from them previously.
They did say that, yeah. Significant strategic value gained before this pivot.
What were the specific problems, say, with Sampo?
Sampo faced some major headwinds from external stuff. Stopping business in Russia due to the conflict was a big hit for their harvester and forestry machines.
Okay.
And then lower oil prices hurt harvester sales in Algeria. They have a JV there, big market share.
So geopolitics, commodity prices, real-world impacts. Is the cleanup mostly done there?
For Sampo, mostly, yes. They mentioned INR, 654 crores, about $78 million US, in write-downs. That part's largely complete. Still some work on Man Japan, though.
And you mentioned weak international markets hitting farm growth earlier. Did that impact targets?
It did. They acknowledged international farm growth didn't meet hopes because of slowdowns pretty much everywhere, including South Asia, like Bangladesh. But despite that, they're still targeting 2x growth in international farm business by FY26.
2 times growth after a weak year. That seems ambitious. How?
Yeah, the exact how wasn't fully detailed in the section we reviewed, but the message was basically execution again. Replicating what worked domestically, leveraging partnerships.
Okay, let's shift focus slightly. Beyond auto and farm, and those businesses needing cleanup, they have Tech Mahindra and Mahindra Finance. Big scale there too. Updates.
Right. These are positioned as having scale but needing to improve their competitive standing versus peers. Tech Mahindra seems to be on a strong trajectory. Good deal wins, pipeline building up, especially consumer, BFSI, good momentum in Europe, APAC.
And financially?
Focusing on margin expansion, EBIT was 9.7%.
Yeah.
And really significant profit growth, over 80% year over year.
80% profit growth. Wow. Okay. Mahindra Finance, MMFSL.
Also strong trajectory. Grew assets loans by 17%. Importantly, kept asset quality in check. Gross stage 3 loans, the overdue ones, stayed below 4%. Better than their own target of 4.5%.
How'd they manage that?
Well, they mentioned deliberately slowing down new lending for a bit. Focused on controls, asset quality, before pivoting back to growth. Consolidated profit up 16%, standalone 33% after some cleanup in rural housing.
So these other big units are also performing well, strengthening foundations.
Exactly. Which kind of leads into how they're thinking about the future. Nurturing new growth. They've refined how they look at their portfolio using 2 axes, competitive position and scale.
Makes sense. Figure out where everything stands.
Yep.
And that led to identifying growth gems.
Yes. These are the future engines they're really focusing on, split into 2 types, scalable and emerging.
Okay, tell me about the scalable ones first.
These have already proved they have a competitive edge, and the targets are ambitious, aiming for a valuation of $2 to $3 billion each. By FY30. That's the next 5 years.
$2 to $3 billion each. For businesses outside the current core, that's aiming high.
It really shows the potential they see. The emerging gems, on the other hand, have promised good products or services, but haven't quite proven market competitiveness yet.
And their target?
Reach $1 billion valuation each in the next 5 years. The goal is to move them up the ranks, improve competitiveness, and scale over time.
Right. Let's get specific. Any updates on these growth gems? Hospitality.
Yeah, hospitality through Mahindra Holidays. They've grown room inventory quite a bit. 3,700 rooms in FY20 to 5,800 now.
And the plan?
Grow that 2 to 3 times in the next 5 years, aiming for 5x over a decade.
Okay. Logistics was mentioned as having had struggles.
They were pretty open about that, yeah. Past struggles.
Yeah.
But they expressed, strong belief in its potential and their positioning. New leaders setting 5-year targets. Placeholder goal is 3x growth right now.
3 times growth in logistics.
Yeah.
What about real estate, life spaces?
Real estate is where they put out some really eye-popping targets. Committed to massively increasing pre-sales. Targeting INR 9,500 to 10,000 crores in pre-sales over the next 5 years.
Wait, hang on. From 670 crores previously to nearly 10,000 cores in 5 years? That's huge.
It is massive. They framed it as a 14x improvement over 10 years, looking at the trajectory.
How is that even feasible?
Well, the critical piece they noted is that 70% to 80% of the land needed for those next 5 years of sales is already acquired.
Ah, okay, so it's not about buying land.
Less about that, more about pure execution on projects they already have lined up.
Wow. 14x improvement, mostly execution on owned land. That takes serious operational chops.
Absolutely. And they stressed focusing on project profitability and, customer experience as keys to actually pulling that off.
Any other scalable gems get a mention?
Susten, their clean energy arm, is on track for its 5x growth plan, committed to hitting it before FY30. And last mile mobility, LMM, the small commercial vehicles, three-wheelers, called a fantastic story.
Why fantastic?
It's already achieved 5x growth in volumes. Went from 14,000 vehicles a year to 78,000.
5 times already. And it's still a growth gem.
Yeah, because they see more potential. Plan for another 2 to 3 times growth from here. Could be 10-15x over a decade from where they started.
And it's performing well now.
Holds over 40% market share in a competitive space. Profitable in FY25, revenue around 3,000 crore plus.
Okay. Then there was the recent acquisition in trucks and buses, SML. How does that fit?
They classed SML as a good buy, fitting their strict M&A criteria. They're disciplined, right? Only buy if it delivers scale, market-beating returns, strong customer value, execution ability, and reasonable valuation. SML apparently ticked all those boxes.
Reinforces their strategy. And briefly, the emerging gems.
Mentions CLPL specifically. Has promising award-winning products. Expect those to translate into revenue soon, putting it on a better footing.
All right, let's circle back to auto now for that deeper dive. Future stuff.
Okay.
Product pipeline, capacity, EVs. What's a product roadmap look like near term?
Okay, so out of products planned by 2030, 6 are already launched.
Oh.
Looking at calendar year 2026 specifically, expect 3 new IC products. 2 are mid-cycle refreshes, plus 2 born electric vehicles and 2 LCVs.
And there's that big date coming up, August 15th, about a future platform.
Yes, August 15th, they'll discuss their new platform vision. It's a foundation for products starting 2027 onwards.
But not a new car launch on that day.
No, they were clear on that. It's a reveal of the platform itself, maybe some concept vehicles showing what it can do, not product launch.
Got it. Underlying architecture for the next gen. What about making more cars? Capacity expansion?
Definitely ramping up. Mentioned increases for existing high-demand models like Thar, the new 3XO, and crucially, building significant new capacity 1.2 lakh vehicles worth specifically for that new platform at the Chuckin plant.
A whole new line.
Yeah. And plans for a greenfield plant, a totally new factory from FY28 onwards that'll support new products, also help debottleneck existing lines.
Does that new capacity number, 1.2 lakh, directly translate to that much extra volume growth?
Not necessarily one for one. They explain some new products on the new platform might replace existing models.
Oh.
So capacity goes up, yes, but some existing capacity effectively gets swapped out for the next gen stuff. It depends on the product replacement cycle.
That's a good nuance. Refreshing the mix, not just adding.
Yeah.
Okay, let's go even deeper on EVs. You mentioned the revenue share win. How's the current sales mix affecting things?
Yeah.
Margins.
Right now, demand, bookings, and deliveries is heavily skewed. Over 75% is for the top-end variant, what they call Pack 3.
The most expensive one.
Exactly. They expect that to shift, though. As test drive vehicles for the lower Pack 1 and 2 become more available at dealers, they think that mix will balance out.
And that shift is needed for volume growth.
Precisely. High-end is great, but to hit overall EV volume targets, they need those lower packs to contribute, aiming for maybe 25-30% from Pack 1 and 2.
And they learn something interesting about what customers want in those lower packs.
Yeah, fascinating insight. Strong demand for the bigger 79 kilowatt battery pack, even in lower trims. Why? Range. Customers want that 450, 500 plus kilometer range.
Even if they don't get all the other premium features, range is king.
Seems like it. They see that long range as a big differentiator, claim nobody else offers it in those lower variants, so they plan to re-variant, basically offer that big battery in lower trims to meet the demand.
Makes sense. How do EV margins look generally, and do they benefit from being built alongside ICE cars?
They pointed to big operating leverage benefits from sharing the Chakan plan. Common paint shop, utilities, even flexible manpower between ICE and EV lines.
So fixed costs aren't a huge separate burden for EVs.
Less so, yeah. And depreciation on the EVs launched is fully hitting the books from Q4 FY25.
So leveraging existing assets helps. What are the main levers for improving EV margins from here?
Three main things. The battery pack mix shift we talked about, changes in selling price, which they mentioned, are indexed to global prices with a lag and just overall volume, which helps absorb fixed costs like depreciation, plus ongoing cost reduction programs like they do for ICE.
They shared some funny learnings, too, from early test drives.
Oh, yeah, this was great. Found test drivers were using the EV's instant power really aggressively, basically driving them like sports cars in the city.
Huh. Driving SUVs like race cars. What did they do?
It prompted them to add a default mode that feels more like driving their XUV 700 less punchy off the line, and they added a voice message reminding drivers to be responsible. Shows the kind of real-world feedback they get.
That's a very direct response. What about software updates? Any hiccups there?
They admitted some initial issues, yeah. Mainly internet speed challenges during the update process caused some delivery delays.
Uh-oh.
But they fixed it by stopping deliveries of cars that weren't fully updated. Plan continuous updates, Apple CarPlay coming soon. Said fundamental customer satisfaction is high, despite those early software snags.
Any other feedback?
Mentioned ADS, the driver assistance systems, being a bit too active in heavy traffic. They intend to address that via updates, too.
Okay. What about the government's PLI scheme for EVs? Are they getting that benefit?
They applied for the XUV9E, and it meets the rules. But they're being cautious, waiting for the official technical certification expected Q2 before they actually book the benefit in their accounts.
And when they do book it?
It'll be cumulative, backdated for all eligible sales from day one. They describe the financial impact as meaningful, so potential boost later.
How do they see their edge, their sustainable lead in EVs, especially with new players coming in?
Several things. One, aspirational value and design at accessible prices. Two, high-end features like fancy music systems, auto park assist, usually found in luxury cars. Three, the actual EV driving experience, quiet, smooth.
Makes sense. What else?
Big incumbent benefits. Using existing factories like Chakan saves massive upfront costs compared to a newbie building from scratch. And crucially, their huge dealer network, 300-plus outlets across all tiers of towns, very hard for new global players to replicate quickly, get some deep market reach.
So product appeal plus established infrastructure.
That's their argument. They see themselves in a unique sweet spot, not burdened by old legacy ways like some OEMs, but having deep auto knowledge plus flexibility.
And software, critical for EVs. How are they handling that?
Big internal team, 200, 300 people, but also multiple partnership suppliers, maybe startup investments, working with tech experts like in Israel. Key thing is, they aim to retain IP ownership, like on the battery management system.
Okay. Overall, how are they feeling about auto demand?
Still optimistic about vehicle penetration growing in India. It's still low, 10, 12%. They think their strong product lineup lets them grow faster than the market in FY26, just like they did in FY25.
And EVs add to that.
Yeah, see, EVs is mostly incremental volume, not massively eating into their ICE sales. Exports picking up too, South Africa, Australia.
Okay, let's switch back to farm. Those market share gains, 43.3%, best ever. How did they do that? It wasn't just one thing.
No, definitely not one silver bullet. They said it was many small initiatives consistently applied over 8 to 10 quarters, like 2 years of work.
Give me some examples. What kind of initiatives?
Okay, one was filling product gaps. Launched Swash Target and Mahindra OJA in the lightweight horticulture segment under 30 horsepower tractors. That was a weak spot. Those gained about 5 share points just in that category.
Strategic product placement. What else?
A big relaunch of the Swaraj brand, Naya Swaraj. Enhanced product, plus bringing in MS Dhoni, who's an actual farmer, as an ambassador, added a kind of youthful, modern feel.
Interesting. Product, branding, authentic endorsement. What about the main Mahindra brand tractors?
Actions there, too. Refreshed the YUVO range, made it more mainstream, accessible, improved product suitability for certain farm tasks, made cost tweaks on the Yuvraj range for affordability, growth.
So product improvements across the board. Anything else contribute?
Yeah, I mentioned channel work dealerships, improvements in manufacturing, quality, and just getting a much deeper understanding of customer needs. They described the whole package as not easily copyable.
Right, a combination of things. Looking ahead to FY26, where do they see tractor demand being strong in India?
Expect South India and Maharashtra to be favorable for industry growth. Chhattisgarh was tough before, Maharashtra actually turned around nicely in FY25.
And their position in those strong regions matters.
It does. They're competitively stronger with both Mahindra and Swaraj brands in the South and West. So if those regions grow well, it gives their overall market share a positive boost, kind of a weighted effect.
And underlying all this market share success, their core philosophy is
Focus on execution. Market share gains are a result of good execution, not something they chase by, say, slashing prices irrationally.
right, focus on the process, results follow. Let's talk money, financial strength. The transcript mentioned strong cash generation.
Very strong. Generated close to INR 10,000 crores in cash from operations during FY25.
1,000 crores.
Yeah, that boosted their total cash balance across M&M standalone and key subs like the EV unit and LMM to INR 28,000 crores.
28,000 crores in cash. That's a lot of firepower.
It is. Gives them huge flexibility, capacity to invest in those growth businesses we talked about, like the SML acquisition, funding subsidiaries, and they expect to keep generating significant cash in FY26 too.
So well funded for those ambitious GEM plans and core investments.
Exactly. Which kind of wraps up their overall strategy, doesn't it? Leveraging the strong core auto farm to generate cash, funding and scaling up these promising new ventures, the growth gems.
While staying disciplined on how they spend it, like with the SML acquisition criteria.
Right. It paints a picture of a group building on its strengths while actively shaping its future growth engines.
Okay, quick recap then. M&M delivered strong FY25 results, driven by execution, market share gains in auto and farm, strategically pivoting some international units, good momentum in TechM and MMFSL, clear, ambitious plans for growth gems, optimistic about India's growth story, and financially strong enough to invest.
Yeah, it's a story of leveraging decades of strength while really sculpting the businesses for the future.
Which leaves us, and you listening, with maybe a few things to think about.
Go on.
First, those growth gems, ambitious targets. How do you think they'll manage that balancing act, investing heavily there while keeping intense focus on winning in the huge, competitive core businesses? That needs careful resource allocation.
Good point. Can't drop the ball on the current moneymakers. Also, that August 15th EV platform reveal, what specifics could they announce that might really shape things up? Not just for them, but for the whole EV landscape in India. What tech or strategy shifts?
Yeah, what's behind the curtain. And finally, execution. They stressed it was key for FY25. Looking ahead, how does that focus continue to deliver results, maybe market share gains, in what could be a mixed, maybe challenging FY26 market, especially in areas like farm with those regional variations?
All really interesting questions to mull over. We've covered a ton of ground today, really unpacking M&M's Q4 FY25 call-in materials.
Hopefully this deep dive gives you a much clearer picture of where M&M is now and their roadmap ahead.